What's up, Chris? We're live today.
We're live today. That's exciting. So welcome everyone to the On the Rocks podcast, the podcast where we talk about accounting and accounting adjacent information, mostly as it relates to e-commerce, but not only. I'm Christino, and I'm here with my co-host Jay Kimmelman. Last week we talked about cybersecurity and the impacts it can have on your business or to you as an advisor. Today we're going to talk through some financial ratios, some metrics, and some KPIs. We'll highlight our favorites and probably our least favorites. We'll identify several that should be critical to you, how to calculate them, and what they mean to you. Let's call it a beginner's guide to financial analysis. But first, what are you drinking today, Jay?
Good question. Today's a double kind of day. I got a double bourbon and Coke today, and I am using the ice from the new ice. What do you call them? The molds for the large ice cubes that my wife got me for Christmas. I'm really happy about that.
Oh yeah, okay, like that.
And I probably would have gone with 2 cubes in this if I had a taller glass. Might have went for a triple today because it's that kind of day. And yeah, not usually that way on a Friday, but yeah, it's been one of them days.
Hey, there you go. Sometimes that's the best way to bring it on Friday. The triple bourbon on ice. Triple coconut on ice. What kind of is it bacon or something?
No, it is 1792 today.
1792.
Yeah, broke out the good stuff.
It really is that kind of day.
It is, yeah.
All right. I today am having a beaming wand. This is from a local brewery here in the DFW area called Pegasus City. I've had this one before. It's a Belgian style wand. And it is very tasty, but today it's also very fizzy. So that's what I'm having today. Before we get started,
cool.
We have one person who's watching. It sounds like it might have an echo, so we might want to look at that.
Oh, do we? Okay, thank you.
And while you're looking into that,
I think we're good.
Go ahead, Jay.
I think we're good there.
Okay. All right. Wonderful. So we talked about what we're going to drink. What happened this week, Jay? I saw the pictures. I didn't realize it was real. I thought it was a flashback, but it looks like we had one of the best NASCAR finishes of all time, maybe.
Yeah.
Is that right?
So yeah, we were in Atlanta, which this was the 5th race on the Atlanta track since it's been reconfigured, and it's a mile shorter than the Daytona Talladega speedways, but it's now a drafting track, and it was pack racing, and we had the big one on lap 2. We had the big one on lap. It was like 9 to go, and then we had another one with 1 to go, and they basically lined them back up, and they had what's called green-white checkers, and checkers could have a couple of different meanings there. Because checkers just replace that with wreckers, and it's one way or the other. So as they come to the line,
that's what happened at Daytona, right?
Yeah, pretty much. Yeah, exactly. So as they're coming to the line, I guess Bubba pulled off of Blaney and allowed the 2 cars to the right of him, Kyle Busch and Daniel Suarez, to catch up. And the memes around this, I don't know if you remember from Cars, Mater coming up to the finish line, sticking his tongue out, and he won by a tongue length. Well, yeah, it was a 3,000th of a second margin of victory. And it was, you would think that'd be the closest race ever in NASCAR. It's the closest speedway race, but it's the 3rd race in NASCAR history. And it was an amazing.
You said the 3rd closest? Yeah, that is amazing. I love those close finishes, and then I love seeing that on my Twitter feed, like running through those the pictures of that last second heroics and whatnot. Let's talk about other things that happened this week. I was reading that Zero and Jax AI have something going on.
Yeah, Zero is making that leap into generative AI, and Watching the release of it, it's very. It brought me back to 2016 when they started talking about the chat bots and how it was going to work with Zero at the time. And I can't wait to
Yeah,
test it out and see if I can actually change an invoice on the fly like that. So I'm excited about it. There's a lot
that'd
of
be
good
great.
things coming,
Yeah,
and
yeah.
start thinking about ZeroCon come this August. It's going to be awesome in Nashville. Buy your tickets
There you
now. I'll
go.
post a link.
That's a great idea. It's a great idea. I bet there will be more detail as we get closer and closer to that being fully
For sure.
operational and everything else.
Yeah.
But it was exciting to read about that that an accounting system is partnering with Gen AI
Yeah.
to make continued progress.
Yeah. Yeah.
Um,
I'm gonna
I
check it out. I'm gonna see if I get some access to it, an early
Yeah,
access to it. See what I can do about beta on that.
there you
Maybe
go.
do an unboxing video of that and see where we go with that. So
Oh, that sounds fun.
yeah.
I like that a lot. I there were a couple updates that I saw this week also in the audit or financial reporting space. One, it looks like the PCAOB might be reconsidering their audit non-compliance rules, uh, which to me as a former auditor is a very positive change. What the PCAOB had indicated to auditors was that they were responsible for evaluating all non-compliance related issues for companies. There's some audit standard activity around non-compliance and the work that you're supposed to do, but it is extremely burdensome for an auditor to have to think about like every single thing that they need to do as far as it comes to non-compliance rules. And so um, that the PCAOB is considering like being more lenient on this, I think is a really good progress piece. The PCAOB also issued their inspection reports from the 2022 audits for some of the bigger firms, and so I think that's going to be. I looked through them at a very high level, and I think that I think there's a couple key pieces of information that you want to take from this. The PCAOB has very strict rules around what is an audit, what's audit compliance, and what's audit related issues, that kind of thing. And so their inspection reports, if you blow it in any area, that may indicate that you have an audit related failure. But when I look at PCAOB inspection reports, that's not really the thing I look at. The thing I think that's the most important is whether or not the accounting firm would change their opinion. And at least for the big four, or well, really for three of the big four, there were no changes to the opinions. So basically, that means that the audit opinion wouldn't have been changed based on the errors that were identified by the PCAOB. Most of the time, those errors are around control testing. Uh, a lot of the time, those big companies, like you're doing a lot of reliance on control throughout the company's environment. And so if you run into these situations where you may not quite fully test every single piece of the control structure around whatever cycle you're talking through or working through, you can get busted on that because you might not have done it properly. Now that just means that you've maybe not done quite enough testing from the PCAOB standpoint, but it doesn't mean that there's rampant fraud happening and loads of misstatements out there and that you shouldn't rely on those audit reports. It really just means that the PCAOB wants a little bit more effort in certain areas related to that. Yeah, Jay.
Your question:
Of
what is the
course.
PCAOB? I think
That's a
we might
fantastic
have
question.
some viewers and listeners that have no idea what that is.
I bet we do. The PCAOB is the Public Company Accounting Oversight Board. I'm pretty sure what that means. Maybe an audit oversight board. I'm not sure exactly what the A stands for, but I'm sure I could Google that. But the but there are two basic types of entities that exist, right? There are public entities. Those are the ones that you would typically find listed on exchanges. They're the ones that need to do reporting with the SEC. The PCAOB is the group that oversees the activity that goes along with those audits. um, and so that means that they're the ones that are defining the audit standards related to that, and they're the ones that are defining like what the rules and around those audits need to be. And each year, they do an evaluation of any company who has issued an audit report related to those public entities, whether you've issued one or 1,000 reports in that year. They look at you. They do a sample of your work to evaluate how good of a job you're doing as an auditor, and they publish those reports publicly. So they're out there for everybody to see. You can see it for every single audit firm, all over the world if that entity is listed as a U.S. entity.
So
Um,
was the PCAOB an offshoot of Sarbanes-Oxley? Is that where it got its origin?
I do think that's where it came from. Yes, it was. It started around that same time to shore up and try to help make sure that auditors weren't doing some of the things that the Enron related auditors and some of those big frauds at the time were doing. Um, I think that as an auditor myself, I think the PCAOB is like they're almost overbearing. They are very um, strict about their rules. Like there's no gray. Like if you
Right.
don't follow the rule exactly, or if you miss by just a little bit, like it doesn't matter. It's a failure to them. And they're and that can be a big issue for compliance. In fact, for the firm that I worked with before I came to HiRock, like we didn't even touch BCAOB issues for that exact reason, because the burden of compliance was so high. And especially if you just do one, you know that one's going to get looked at,
Right.
and you have to spend time with the PCAOB auditor. You have to do all of these things where that cost of compliance is significant. On
Well,
the
as a casual investor and looking at companies that are publicly listed, you hope to have that kind of scrutiny on the
I don't
audits.
know if you I don't know if you need it quite to
Although
that
the
degree.
casual person doesn't understand it to start with.
Yeah,
But
sure. Well, I think there's a couple different things, right? Is the is it, When it comes to like audit standards, most people don't know what those things mean. When you're talking about like a uh, an ITCG or ITGC opinion, right? The opinion over general controls
yeah,
and the like control environment opinion, like not everybody even understands what that means.
right.
and and that's where most of these firms are getting busted, is like something that they did around this, where it's really like, is your control structure correct? Do you have controls in place that are working effectively? And then because the underlying technology environment has gotten so complicated, especially for some of these huge entities where a lot of the transaction activity may not have paperwork associated with it anymore. It may just be
Right.
EDI based.
Right.
Like there's just the the level of scrutiny that takes, at least from the PCOB's viewpoint, is like significant. And so because of that, they're it's really easy to mess that up, because you do have to understand where the data is coming from. You have to understand why the data is valid. You have to understand all the things that go along with that data, which I think is important. It just is very complex,
Right.
and that is part of the reason why at least I personally like the PCOB can be really punitive, because the basic investor, the most important thing is not, did you test every single control perfectly. The most important thing is, are the numbers materially accurate? And
Right.
so I do wish the PCAOB would change the way that their reporting was, so that they understood that these audit failures aren't failures of the financial statements to be accurate, but just failures of the audit work to be like all the way up to their 100% snuff. Because I do think, like you said, like to the typical investor, like the thing that you really want to know, the thing that's most important to you is, are these numbers fucked up? Like that's what really matters. And if that's not being impacted by whatever audit mistake is there, or whatever audit deficiency could be there, like if that's not being impacted by that, then it really is not, to the typical investor. It doesn't matter, but to the like audit firm, yeah, sure, you want to
Right.
continuous improvement and you want to get better and all of that kind of stuff, but you don't want to wear it as a mark of shame for the rest of your
Right.
audit life or whatever.
But looking at it again from a casual investor, you get the annual
Sure.
report and you read the audit report, and it's like,
Yeah.
okay, my investment got an unqualified opinion. It's unqualified. It can't be very good. It doesn't make sense. maybe we need to take a look at an annual report and the auditor's statements and what it means on a future episode.
Yeah, that is actually a topic that I am very passionate about, that I actually was working on just yesterday. I want to put together a summary of all of the different sections of a 10K or a 10Q, to highlight what they're for, and why they can be valuable to lay investors. Because I do think that that is important. There's so much information that exists in those 10K filings about those entities. You can really learn a lot about what you're investing in as long as you know what to look for.
Right.
And you can also spot potential problems, if you know what to look for. And that's some of what we'll talk about a little bit later, where we talk about ratios to evaluate and things like that.
For sure.
So do you have any other questions about PCAOB reports or anything that you think that people would find interesting?
I honestly, being in I wouldn't say I was in a firm that worked with a company and we prepared some 10Q filings with them, but
Sure,
I
yeah.
think the information in it would be very interesting to companies that
Yeah.
are thinking about getting listed
Going public.
public.
Yeah, absolutely.
So
Because it is a much more substantial burden than a basic set of financial statements. So if you're already being audited as a private company, like the reports that you need are only a very small subsection of an actual filing.
right,
And as a general rule, you're only having to do that yearly, not quarterly. So the compliance burden can be a significant undertaking when it comes to listing your company and going public. That's definitely true.
yeah,
So yeah, I think that's something that we can revisit at some point in time. Another piece of news that I saw was that the IRS is coming very hard against fraudulent or maybe misgotten ERC claims and ERC exposures. They're being very generous about it, though, is at least my understanding. Jay, can you tell me a little bit more about how that's working?
yeah. At this point, if you actually come forward and pull back your ERC claim, they will
Yeah.
look the other way. If you've gotten
Yeah.
it and you refund it and send the money back, they will look the other way. So
That's
be looking at that. If you bought into those ads that get 26,000 per employee, it's free money. Well, look at it and go ahead and dive a little deeper into it and see, was it really truly due to the intended purposes? Do you have exposure? And if you do, I would talk to an accounting professional, tax lawyer, somebody like that, and figure out what you can do to reverse it.
Yeah, I think that that's a big thing to think about, because there were very, very set rules around being able to make those claims. And so if you loosely follow those rules, you got to be really careful.
Well,
and so it does definitely be worth revisiting.
and I've advised some clients here in Florida that I did not recommend them to use those
Mills.
using the mills, but those not using a hard and fast rule to qualify.
Oh, yeah.
So
Okay.
if you didn't meet the criteria and they're looking at the closures and the other things, well, in the state of Florida, we were told we weren't shut down. And over the last 9 months, we heard publicly how Florida was open and open for business. So that right there is a proof to me that if you did not meet those numbers at your individual area, look at the emergency orders that were put in place. And if there were no orders, there was no reason not to file if you still made a decent sales revenue and you didn't have the drop off that was required. So I would definitely get refunding that. And then, on top of that, you have to pay it depending on if it was a flow through or not, or if it was a C corp, you had to refile your taxes based on that. And, well, you got to now, if you paid in, then now you have to re-amend again and fix it and get that back. So, I believe the IRS is now slow rolling every ERTC claim, waiting for people to pull them back because it's been so long since it actually happened that
Yeah.
the main reason that they followed was due to those ads, and they are being scrutinized like
Yeah.
crazy right now.
Yeah, definitely. And I've seen at least a couple stories where some pretty significant clawbacks have occurred
Mm-hmm.
because some of these IRS reviews. So definitely, if you think you're on the if you're even questionable a little bit, like do some diligence around that.
For sure.
There's some definite costs there and some opportunity. Jay, you
Yes.
also mentioned to me before we started here, you mentioned the story around the cost of noncompliance and the related unknowns associated with that. Like, you want to talk more about that?
Yeah. So this week I actually did a webinar with Avalera talking about
Oh, okay.
having a sales tax compliance practice. And they threw
Mm,
out some really large numbers around noncompliance. And they're saying the average company that is not paying attention to sales tax, and I believe they're talking e-commerce client, they had a
mm,
$300,000 exposure to sales tax that they had to be filed, and they were
yeah.
able to work through different methods of it to go through a VDA or voluntary
So self
disclosure.
correction program.
Yeah,
Right.
and go through that, and you still got to pay. The penalties are not as bad when you disclose it yourself, but it does open you then up for registration in every one of those states. It opens you up for income tax in every one of those states, and usually on the sales tax they go back 3 years. You know what that means? You're going to go back 3 years on the income tax too. So you want to be looking at
Mm,
that, especially if you are running an e-commerce shop. I think Shopify does a really good job of now telling you that you are approaching Nexus in your specific state. But,
yeah.
and I believe that is specifically in Plus. I'm not sure if it does it in the regular
Oh, okay.
Shopify or not. But,
Yeah.
hook it up to a sales tax app, whether it's Avalera, TaxJar. Let it pull in sales and tell you what you're looking at. You use the trial period to do that and get a quick Nexus study to do it, and find
Yeah.
out how many states you actually have broken that economic Nexus threshold. Now that leads to the next part of it is there's so much non-compliance because
Mm,
of the ever-changing regulatory environment. How many
yeah.
states? How many states do you think have economic nexus now?
No, you want me to just guess? Let's go 32. Like, I have no idea.
43.
Nuts. That's a
43.
lot.
And
What
they
are those thresholds typically? Like, when it comes to economic, like, are we talking $10,000? Are we talking like $1 million? Like,
it
what's it take?
ranges from state to state. Some is based on number of
Sure.
transactions. Some is on a sales volume. One that
Oh,
I know,
okay.
one that's out there is $100,000 of sales in a state.
Mm,
Uh, yeah, and it could be 100 transactions. Things along
yeah.
those lines. So yeah, I mean, Christy was very close. She said 40. So yeah, and the thing about that is you have to pay attention to it because those thresholds are changing on a quarterly basis, especially now
Mm,
as inflation is rising and people are spending less. Well, sales
mm,
taxes are coming down depending on where you are, and other taxes. People are leaving states, and the revenue coming into the states is going down. The only way to
yeah.
increase it is change your
Lots of
thresholds
numbers.
on your Nexus
Yeah.
or increase audits.
Oh,
So either way, it's
yeah.
coming our way in this world. So um, that's a good thing. So yeah, and like Christy said, look at the website without having to do a search for each state. That's a great thing to do. Uh, a good rule of thumb. Yeah, for sure. You can always go on Avalera or TaxJar, and they tell you what the thresholds are in those states. Sorry, I had to read that.
Oh, yeah.
I'm halfway
No
through.
problem, Jay. There you go. That's good. That's good.
We're
That's
getting
good.
there. So
Yeah.
yeah. So
so again,
sales
so just
tax
like
is an
last week,
interesting one, and we're diving
yeah,
a
always
little
can be.
deeper into it at High Rock right now. So
Yeah,
yeah, we
good,
have more coming
good.
on that for
And
sure.
so we've talked a lot about a lot of things that have happened this week. One thing that I think didn't happen this week. Do we have any updates on tax regulations for this year?
Yeah, Senate's not touching it. They're not touching
Yeah.
it with a 100-foot pole. And
Yeah,
with all
I
that
saw something
said,
that they might.
go ahead.
I was saying I thought I saw something that I thought that they were only going to even maybe approach it in April or something. Like, that seems like a disaster to me.
Yeah, at that point, it's too late. I mean, January 31st was too late. Let's face it, because people were already
Yeah,
filing. And we've had
filing.
this
Yeah.
happen in the past, and we had a lot of confusion. People said don't file. The IRS said file, and it was all over the place. The IRS actually went on record and said they feel, yeah, once these changes are passed by Congress and signed by the president, it's a matter of a
Yeah.
week that they can have these changes enacted and put in the system, and they
It
can
was
then
that
have
fast.
I think they're preparing for it. I mean,
Oh,
hopefully
okay.
they're
Okay.
they're doing it behind the scenes. So all they got to do is actually push the button and test
Know if
it and
there's any
see if it's going
tweaks.
to work. But
Right. Okay.
but there was a story that I read actually 2 days ago, and it was
Yeah.
a quote from the IRS commissioner Danny Werfel, and I was very confused about that because being a Florida boy, we have our
Yeah.
former Gator quarterback Danny Werfel, and yeah, no
Yeah.
relation. So.
Okay.
Uh,
All right. That's wild.
So he's went on record and said, yeah, we can get this done pretty quickly. But he also said they only
Mm.
expect about 10% of households to be majorly impacted by the changes. Now, I think it's going to have a
Oh, okay.
bigger impact to businesses because of
Sure.
the depreciation rules that are in place and some of
Yeah.
the other capitalization rules that
All right.
might be being relaxed. But
Yeah.
uh, they did go on record and say that they are planning on, once this bill is passed, on increasing audits of higher earning individuals
Okay.
and companies. And they have also hired 5,000 more agents that are on the phones. And I can attest to you, I called yesterday, and normally you get pushed through to the department you get a message that, there will be a 5 minute to a 3 hour wait. And in this case, that message didn't come up. They answered the phone. And so it was
Wow. Yeah.
good.
Okay.
Yeah.
That's
So
great.
I think around the holidays,
That's
it
fine.
took a little dip, but I think it's coming back,
Yeah.
and
People
it's
take a
been
vacation or
very
something.
helpful. So, yeah.
That's lovely. Glad to hear that. Not glad to hear that there aren't any updates related to the actual tax law itself, but
Come
glad to
on.
hear uh, taxpayers with issues are at least getting able to get through.
Yeah, for sure.
That's wonderful.
But more important than the
Any other news
taxpayers,
and
their
notes?
accountants that are helping them need to get through.
That's true.
So,
Absolutely.
for sure.
Any other news and notes?
No, not
No.
related to accounting at this point. No.
Uh, all right. Well, then let's talk about ratios, baby. Let's do it.
Talk about
Uh,
ratios.
so ratios. Let's talk about some ratios. Let's talk about metrics. Let's talk about KPIs, things that matter, some basics, some beginner information that can help people who are looking at financial statements either for the first time or for the first time in a long time, or for the first time with maybe with a little bit more scrutiny, a little sharper eye. So there's loads and loads and loads of ratios out there. What Jay? Do you have any do you have a favorite one?
Well, my favorite are related to the cash flow topic that we talked about a couple of weeks ago, and that is
Yeah.
AR days and AP days.
Yeah.
The shorter your AR days, the longer your AP days, the better your cash flow. And those are great tools to
Right.
be working to help you increase your cash flow. So those are ones that you
Right.
want to be looking at on a constant basis. And when I say constant, on a monthly basis, you get your financials
Yeah.
from your accountant, take a look at those AR and AP days. And there's a couple other ones out there that are important, but it just depends on
Yeah. We'll
who.
talk about them tomorrow. Yeah. Right. No. I mean, I I definitely agree with that. That one of the things that I always look at if I'm looking at a set of financial statements, one of the very first things I look at is just margin. I know it's a really simple
Mhm.
thing to think about, but like, hey, at the top level, like, how profitable is this business before you like consider all of the stuff that helps make it run behind the scenes? Like,
For sure.
how much money is it making to begin with? Do
Yeah.
we have much going on there? Why can ratios be important? I I think that there are loads of different ratios that exist that give you a lot of different feedback points about what's going on in the business. Like you were talking about cash flow needs and the cash flow cycle, like
Right.
that's a really important thing for a business owner to understand. Is like why am I having these struggles with cash? Like it can very easily be like you're waiting 60 days to get paid, but you have to pay in 30 days, and so you end up with this very like cash tight cycle because you're waiting to get money.
Exactly.
Or things like you're sitting on a bunch of inventory, right? You spent all of your cash on stuff for future revenue because you're making product in China or somewhere and you need a long lead time, right? That because you want to make sure that you don't stock out of your most critical products. There can be all kinds of different reasons that that's important. There, for investors, there's loads of other things that are important as well, like considering you know leverage, like how much of this company did I really buy.
Right.
If you're investing, right, if the company's highly levered, um, then you're maybe behind the scenes, you might not even get the first pass, and if the like if that debt to equity ratio is way out of control, like you may never even get your investment back.
Right.
um, and then I think there are some ratios that also exist around, and we talked about this a little bit before too, of like on the cash flow statement itself. There, like if your operating cash is negative, like you got
Right.
big problems.
Well,
Um, do you,
you asked
yeah,
why
go
are
ahead, Jay.
ratios important? You know,
I
I
did.
think that I think to me they're important because when you're looking at different companies of different sizes and different industries, it it's not comparing apples to apples. You're comparing apples to oranges or
Yeah,
bananas.
bananas.
And by
Right.
doing so, you're right sizing by having it in a ratio form, and it makes it
I
easier
think
to
that's
understand
definitely
it across a spectrum of different companies.
right. And so I love that because what ratios do is exactly what you're talking about. They make companies, and especially similar companies, they make them so comparable. Because if you're selling a product and you have a company that's pretty similar to you that's selling the same product, but these ratios that we're talking about are like significantly different, that may
Mhm.
either indicate to you some opportunities that you have for improvement. It may indicate to an investor like there's this company has a this particular thing that's making them better because they're the ones with the trademark on this product or whatever, right? And this other company is secondary, and so that margin is higher. There could be all kinds of different things that allow you as an investor particularly, right? It allows you to make a decision between two relatively comparable entities, or like you're talking about, Jay, like two entities that maybe are a little bit comparable, but not like not perfect matches or not even all that close matches. But it gives you so much information, and
Well, think
so
about that in a franchise system. You have one store that does $2.5 million a year in sales, and you have a store
yeah,
that does $15 million a year in sales. If you're going to
yeah, that's a
compare
big
them
difference,
by the numbers, they're very different.
right? Of course,
So it
and it
adds
doesn't give you much. I mean, and it just at the top line like that, it doesn't give you a whole lot of insight, right?
right,
But if that $15 million one is spending 14 million to get that 15 million, and the
right,
2.5 is spending half a million to get the 2.5, like that can change the perspective altogether. And so there are loads of people who ratios are important to. We've already talked about investors. You've already talked about the owners of an entity specifically. And I think as advisors, like ratios can be really important to you as well because they can give you those insights that we were just talking about of, hey, this competitor of yours, they have this, their ratios are this way. Like, do you know that that's like different than what you're expecting? Like,
right.
what's causing that difference? Are there things that you're doing that are either better or worse than these competitors? And so that can be useful to loads and loads and loads of people. I know As an auditor, ratios were extremely useful to us because it highlighted areas of risk.
Right.
Because you could identify pretty quickly if there were significant changes in certain areas within the financial statements. Like you could say, oh, there's our debt to equity ratio changed significantly. I wonder what's that about. There's probably something unusual that went on. We need to ask some more questions.
Yeah, your
And
quick
so
and current
ratios can,
ratios as well are important in that aspect as well.
yeah, and from a business owner's perspective, that's true too, right? Those ratios about your current assets and your current liabilities give you a lot of information about like where you stand today and
Hmm.
where you're kind of headed to in the relatively short term, which is a really important to
Yeah,
that
exactly.
business owner for sure. Jay, why do you use ratios? You've already talked about a little bit about comparability. Are there other reasons that you use ratios?
Why? Because it's a great tool for advising my clients. I mean,
Yeah, of
that's
course.
there. But I
Absolutely.
mean, other than that, I mean, yeah, margin of victory. Yeah,
Hey,
three
that's a
thousandths
good,
of a
nice
second.
ratio. Like that. Like that.
So yeah, I mean, there are many different aspects you can use ratios, but financial ratios, you know, I can't think of at this moment, but I do know
Yeah.
that working with a client, we were in the middle of something and reviewing something. We quickly ran
Yeah.
and did some quick numbers and it's like threw some numbers out at them, and those ratios were really important. And the other thing that we track them for with our clients is they might have a mortgage that has specific covenants, and they have to
Mm.
make sure they're maintaining the normalcy of those and staying within the margins that are predicted or required by their mortgage. So, there are a lot of different reasons for having
Yeah.
ratios.
Ratios. Well, and it is funny that you say that because that was always a thing that you needed to watch out for as an auditor as well. As
Mm-hmm.
because if your business has a line of credit or some type of loan and you have some ratio that's built in as a covenant, and you're really close to that covenant number, probably deserves a little bit more scrutiny.
Mm-hmm.
Um, and so there's there were loads of times where within audits, like because a lot of times those are going to be around debt service ratios and and specific like sets of return, like all of these types of things, where the different components of whatever went into that ratio became more important and more risk based, especially if you were tight on whatever covenant that was.
Right.
And so it can really impact you as a business and impact your compliance in lots of different ways for sure. And so we've talked about loads and loads of things. We've mentioned working capital, we've mentioned quick ratios, we've mentioned turns, we've talked about leverage. Like these are all kinds of different things that it's very possible that the people that are watching or the people that are listening have no idea what they mean. So why don't we talk about a few of them? I think some of the ones that I just talked about are probably some of the best ones. Jay, do you have a good quick version of what a working capital ratio is?
Working capital. It's
Or
you
a quick
got me
ratio?
now.
We can do.
You got me now. Make me think. Going back to
Yeah.
school days. Um, I'm thinking it's some sort of cash on hand versus debt.
No, no. So the current ratio is the ratio of your current assets
Okay.
to your current liabilities. And what that tells you as a business owner, right? Your current assets are things like cash, things like accounts receivable, things
Mm-hmm.
like inventory, things that you're going to turn over pretty quickly. Your current liabilities are things like AP and certain accruals, like
Mm-hmm.
your credit card accounts or your accrued payroll or something like that. Things that you're going to have to pay very quickly. And so if you get into a backwards position there, where your current ratio is say less than one, it now becomes imperative on you to find some cash flow funding, um, because yeah, right, exactly. Christy in the comments has talked about liquidity. That's exactly what the current ratio tells you is how liquid are you?
Right.
How much can you take with what you have as your current assets and be able to pay off? That's very similar, I think, to the quick ratio. which is also an evaluation of liquidity. The quick ratio, though, doesn't include everything else. It doesn't include your inventory, right? It just includes your current receivables, your cash, and those types of things, and other short-term assets. And so it's even like that much more quick. Like,
Right.
how much cash do you need really, really quickly?
Convert
And so
quickly.
these liquidity ratios, yeah, the liquidity ratios are really good at giving you a picture of where you are right now, and and what your cash flow needs in the short term are going to be. Whether you can weather a storm, or whether you need to generate new business, or turn or something to that effect, right? Where you may already have inventory that you need to sell through. Maybe it's time for a sell,
Right.
because you need to generate a little bit of other assets, but without incorporating or adding up extra liabilities, for sure. Um, well, how about I'm going to try and test you again. This one I feel like you're going to be much better at, since it's your favorite one. Talk to me about turns, Jay.
So turns is, if you look at it from an inventory standpoint, it's how many times you turn over that inventory in a year. So
Yeah,
if you are on a just-in-time type of thing, you're going to be doing it on a much larger scale. You're going to be turning your inventory much more often. And if you have a
right.
lot of old, obsolete inventory that doesn't sell, it's going to impact that and make your turns lower. So you really want to look at that and ensure that you're dealing with that and not having a lot of stale inventory, because what happens is, if let's say it's a technology related piece of equipment, it's
Right.
going to get obsolete. You're not going to be able to sell it, and you're going to end up having to write it off. So that investment of
Yep.
whatever you made for that product is going to go to the bottom of your P&L as a negative number, and you don't want that to happen.
Absolutely.
So you want to
really
be watching that and pay attention to your inventory. And one thing that I always try to tell my clients that are selling inventory is run a report and make sure that you are selling that product. Look for that slow moving inventory and drop the price on it. Get it out the door, because next thing you know, the new model of that product's coming in, and then you're never going to sell it. So sell it and turn it over. I mean, even if you sell it at cost, get it out the door, because if you don't, you're going to end up eating some of that. So
Yeah. And
yeah.
so turns is definitely a term that we use, but I think that you described that well, of what that really means, because it is the turnover of whatever that asset is. So inventory turnover is the amount of times that you turn inventory. And so it typically will give you, and it's typically based on how many times you'll turn inventory in a year. And so if you have 12 inventory turns, you're flipping your inventory every single month. If you have 24 inventory turns, you're flipping your inventory every other week. And if you have one inventory turn, you probably have problems, because you're only selling through your inventory once a year.
Yes.
And so that can be a really good metric for you also, to identify whether or not you're overstocked. Even so, if you don't have some of those technology related issues, where your product's going to be, say it's a nutraceutical, right? Your product is probably going to be okay, and not be exposed to obsolescence that way. But a nutraceutical is going to be exposed to other kinds of issues, right?
Yeah.
Because it might expire, and so
Right.
you do want to make sure that you're evaluating your inventory turns to help you to manage the inventory level that you want. And so if
I
you're
can
talking about,
tell
say,
you,
just
when you're talking about nutraceuticals and the like, though, that you can, if it's approaching expiration date, you could pull samples off your shelf and send it in for lab testing and make sure the efficacy is still there. And you can then extend the expiration date. Because it's really a best used by date is what in nutraceuticals, what it really is.
Mm-hmm. So
yeah,
right.
Thank you for bringing up something that I have an expertise in.
Hey, that's what I'm here for. I gotta make you look good sometimes, Jay. Can't just be asking you questions you don't know about. The other types of turnover ratios that I think about are some of the ones that you brought up as your your favorite ones
Oh,
because
sure.
AP turns and AR turns, they're just the inverse of days in AR. And so what they indicate to you is exactly the same thing as inventory turnover. They indicate to you how quickly you're paying your payables and how quickly your customers are paying your outstanding receivables. And so if you think about that, again, if it's one time, right, you have an entire year's worth of AR outstanding, that would be a disaster. And that means that your customers are paying your payables every 360 or your receivables every 365 days. And so as you tighten that up, your days are just the inverse of the turnover. And so those can, like you mentioned before, those two ratios, your AR turns or your AR days and your AP days, can be extremely valuable to you as a business owner because it helps you to understand potentially where you're going to have cash flow pinches. And it's going to do a lot to drive that current ratio that we talked about before. Because
Right.
if you have longer AR terms and shorter AP terms, your current ratio might look good, but you might still run into cash issues because you're waiting on people to pay those outstanding AR balances. These ratios are both pretty critical. What if you're a company that's issuing terms to your customers, like you would expect that your AR turnover ratio is going to kind of level out around that turn rate that you provide, right? And so that gives you a good indicator of whether or not your people are short paying or like long paying you or early paying. And so it can also be a good metric of your overall financial stability or your customers' overall financial stability. Because if you give 30-day terms but your AR turns are 60 days, then like people aren't paying on time.
Right.
people are slow rolling those payments, and so that can be a really valuable thing to look at as well. Um, and the same with your AP turns, because if you are typically being offered 30-day terms, but your AP turns are your AP days are only 15, then that you maybe are leaving some opportunity on the bone there because you're paying faster than you might be required to. So those are definitely ratios to look out for.
And
One other that we talked about. Oh, go ahead.
both of those are negotiable. I mean, you can reach out to your suppliers and your customers, and I mean, if you want to increase your cash flow, you ask. If you have a good payment history, you ask your supplier, "Hey, can I get an extra 15 days?" And that buys you an extra 15 days on the back of that. So, you know, if you have a good credit history with your vendors, I would definitely reach out and say, "Hey, I need a short extension on that. Let's go from 30 to 45 days." Or, I mean, ask for 60, and they can come back and say, "Okay, go 45. It's good." So,
Yeah.
yeah.
And it's definitely worth asking because it can help your cash flowing situations so much. Those extra few days, especially if you start to line them up or get your receivable turns in a favorable position like that, that can be huge to you and your business.
Hmm.
Absolutely. One other ratio that is an important one is our leverage ratios, and so that's how much debt do you have outstanding, and how does that compare maybe either to your assets in total, or your equity. So that's the debt to equity ratio that I mentioned before. The That amount of leverage, like I talked about before, really does help you to understand if you're, especially as an investor, it like helps you to understand like how much uh, how much exposure you have to not getting your investment back because of potentially priority returns. It also helps you as the business owner understand kind of how much exposure you have to interest, um, and it's going to significantly impact your cash flow as well because that debt is often going to come due. Most debt does, and so it can be very important for you to understand what that ratio looks like and especially how that ratio is trending over time. Um, because if you find yourself higher and higher leveraged, there will come a point, I think, that interest is going to just kind of eat you alive. And so you want to make sure that that's something that you're evaluating and something that you're monitoring, um, so that it's something that you can also manage and maintain. Do you have thoughts on the leverage ratios?
I just want to say it's so important today with interest rates, higher than they've been in the last 3 to 5 years. So, you are so right. If you get caught behind the eight ball there, you could being for a day of reckoning there. So yeah,
Yeah, right.
got to be paying attention to it because that interest will
Yeah,
eat
and that's true too. Even if you got the very favorable EIDL loans, a lot of those were adjustable rate.
you. Yeah.
And so those SBA loans, they started off as a like significantly wonderful option. They were very valuable to you as a business owner, but because those rates are adjustable, they're not as valuable anymore. And so those leverage ratios and being thoughtful about what your leverage looks like can be really important to how you're able to manage your overall cash flow and also how you're able to manage your business. Because if you're paying something like 10% on a loan, but you have some excess cash, it may be worth paying down those loans instead of just sitting on that cash.
Now, you mentioned the favorable terms on the EIDLs, but many people overlook the fact that if you were a pass through, you could not take distributions without getting approval. You couldn't sell
Mm,
your business without paying off that loan or getting the approval. So there are some sticking points there. So I mean, just
yeah.
as you have to review the ratio and the other financial requirements, there are other requirements to some of
Yeah.
those things you got to pay attention to.
Yeah, definitely. And so when it comes to loans, that's definitely true. There are all kind those are really basic covenants, right? You don't think about them, but they are truly covenants of like things that you as the loan holder have told the person who's giving you the money, I'm not going to do X, Y, or Z without your authority. And so those can be really important for you to manage because they can call those loans and you have to pay them back right away. And if you
Hmm.
don't have the cash to do it, that can become a significant problem, and it can become a significant problem really
Very
quickly.
problematic for sure.
Yeah, I have a few other ratios that we've listed here, but I'm gonna touch on just one of them, I think, because we've been chatting for a while now. And this is one that you brought up when we were talking about this very briefly yesterday, and that's allowance ratios or ratios related to reserves. I think these are very valuable things to look at, and and certainly again from an audit perspective, they're things that an auditor is always going to have some consideration around and some extra thought around. Jay, what are your thoughts around allowance ratios?
Well, I think it's important to be looking at that, whether it's AR allowances, inventory, obsolescence, ratios, and
Reserves,
you
yeah.
got to pay attention to it. And the thing about it is, the auditors don't really care what method you use to come up with those, just as long as they're consistent and they make sense. And you can't just
Yeah, as
say,
long as
I think this year I'm going to have 50% of my AR as bad debt when historically you've had like 15. So, it's really
yeah.
important to understand how much AR write offs you've had or how much inventory obsolescence you've had. Because if you're going to start swinging to much higher and then lower, you know, rates to book your allowances, yeah, you're going to run into some issues. And not only will it be your auditor, it could also be an IRS auditor looking at those things too if
Mhm.
you're on the accrual basis. So, yeah,
Yeah.
got to pay attention.
And so I laugh at that because to me that's exactly the like one of the easiest ways to purport or to commit fraudulent financial reporting is by massaging your estimates, by massaging those reserves, by saying, oh yeah, hey, we're kind of right around the net neutral this year, so let me go ahead and take a bigger loss by increasing my reserves by a bunch, so that next year I have
Yep.
this like cookie jar to draw back from when I
Right.
when I might need to pick up a little extra profit or something like that. And
Yeah.
so uh, and so those are things that auditors look at all the time. Both financial statement auditors and I'm sure the IRS auditors think about that too, because if you're right at a tax neutral, and then you become very tax negative because of these extra reserves.
Yep.
There's certainly some exposure there, and I bet there's even some more exposure if you're like if you've taken these reserves and become tax neutral, where
Yep.
you've become kind of like net zero ish, but because you've increased your reserves significantly, I think there are a lot of people that would think that that's pretty clear evidence of maybe some financial shenanigans.
Correct.
One One last ratio that I want to touch on, and it's because it's very, very important to e-commerce businesses, especially those that are solely e-commerce businesses, is your ROAS, or your return on your ad spend, because a lot of companies, especially if you're a discretionary product where people might not know about you, or people maybe just may may know about the product that you sell, but not know about your company specifically. The easiest way for you to find them is through social media these days, or through other types of advertising. If somebody's Googling, right, you may need to spend some money to have your product show up in the higher ends of those Google searches. And so that return on your ad spend can be really, really critical to you as a business, because it tells you kind of what that's worth to you, and how valuable that's been. That the the like typical staple that I've seen around, and I know that this fluctuates from business to business, is kind of like 4. So there are like expected return on ad spends, and so there's a lot to look at there, because if you're significantly higher than that, then it may be worth turning your ad spend up a little bit more, and seeing a decrease in your overall return on ad spend, but having your sales like significantly increase. And on the opposite end, if your return on ad spend is really low, then maybe there's a different and better way to spend your money. And so business owners, especially in the e-commerce space, and especially in those discretionary products where you need to build a market share and people need to know what your product is, ROAS is something that you would definitely look at, and that you should be looking at really closely. Um, what do you think, Jay?
No, I definitely think so. And
Yeah, and so Jay, I don't know if this is on the feed altogether or just for me, but I
no, it's
can't hear
you.
you talking.
Yeah, that was
Oh,
me. Yeah, I actually muted myself. I thought I unmuted. I had a sneeze, and I didn't want everybody to hear that. So
there
yeah,
you go.
but yeah, but real quick, we had a client. I was looking at their financials, and they are
Yeah.
selling. They're on like 7 different marketplaces on Amazon, and they're doing
Okay.
a
Yeah.
ton of ads in each of the different countries. And it's like you look
Mm.
at, they were spending more on ads than they were making in sales in some of those countries.
Oh wow. Yeah.
Yeah.
Wow.
So it's like I think it's time you cut bait there, and you look at the EU
Yeah.
countries, and it's like, yeah, your product's not hitting there, but you go to the Great Britain, yeah, you're knocking their socks off there.
Mm.
So yeah, move that
That's
ad
right.
spend over there. So yeah, it's really important to be looking at that, and whether it's those social media ads hitting and getting the numbers you're looking for, whether it's AdWords or whatever Google's calling them these days on YouTube, or
Yeah.
Facebook, Instagram, TikTok,
Yeah.
whatever. Look at that and then start using it and measuring what your ROAS is, because it's important. And if you're not hitting it on something, do some A/B testing and test with those different avenues, and run the ROAS on each of the different tests and see where you're hitting. And it might be worth
Yeah.
trying 5 or 6 different things to find that one perfect method to get your advertising message.
Yeah. Absolutely. Absolutely. ROAS is really critical, and there are lots and lots of ways to look at it, and lots of things to do with the information that comes from it. Um, so I think Jay, that's a beginner's guide to financial analysis. We've talked about a lot of different ratios. We've talked about why they're important, and we've talked about the ones that we like the best. But last, what's going on next week?
Next week I am getting on a plane going out to Arizona on Monday.
Ooh, buddy.
Spending the week
Yeah.
at a client, and looking
Yeah.
forward to that. We've been doing an ERP implementation for the last 6 months, and they are up and running. And now it's time to take it to the next level.
Oh boy,
Uh,
that's
building,
exciting. Should
Start
be
building in some
good
automations
fun.
and fun stuff. So yeah, looking forward to it.
What's the weather in Arizona like next week? Are you going for just the right time? It seems like this might be the best time to go to Arizona.
Let's actually look that up real quick. I don't recall. It's Same as it is here in Florida, mid 50s to
Yeah.
mid upper 70s. So yeah, I'll take that
Oh
any day.
yeah, that's pretty.
Yeah,
That's pretty beautiful.
yeah.
Wonderful, wonderful, wonderful weather. Any special weekend plans this weekend?
Uh,
Where are we racing?
we are racing in Vegas. I actually thought
Oh, there you
about
go.
going out early and going to Vegas and taking in that
Yeah,
race, but then it's like,
yeah,
no, I'm already in Phoenix. I'm gonna spend the weekend there and hit the spring race in Phoenix. I've been there 2 years for the championship weekend, and looking forward to getting back out there
yeah,
and spending some time there.
yeah. That
Um,
be a
but
lot of fun.
but this weekend, considering I'm going to be gone for the next 8 days, I figured I'd spend some time with my daughter. But she's gone already. I won't see her till
Oh no!
she's spending the
Oh
night with a
no!
friend. She's got dance rehearsal tomorrow, and then
Oh,
she's going to a friend's birthday. And so maybe I will see her Sunday. Maybe I can get her to take me to breakfast or something. So yeah,
yeah. Well, good luck. Good luck with that.
yeah,
We've got another birthday party with little ones friends, so we're gonna definitely do
yeah,
that. But otherwise, not too much on the weekend plans. The weather here in the DFW area seems like it's going to be similar to Florida and Phoenix, so we're going to probably do some park time, I'm sure. Try to enjoy some time outside as much as we can. So
oh,
so get outside, everyone. But otherwise, not too much going on. And do we expect any big or exciting accounting related or e-commerce related developments to come up in the next week?
I don't
We'll
know.
find out, huh?
We will find out for
We'll
sure.
find out.
Yeah.
Yeah. Well, thank you to Christy for all of your comments today. Thank you to the couple of viewers that we had along the way. We really appreciate you coming live with us, and we're really excited for these live versions of On the Rocks. We look forward to hopefully talking to you next week if we can get Jay on some good internet somewhere.
Yeah,
Um,
we'll take care of that.
all
I don't
right,
know if
love
I'll
it,
have
love it,
as
love
good a
it.
camera with me. Actually, I will have my camera with me, so maybe I can. So
There you
yeah,
go.
we
Super,
shall see. So I'm
super,
planning on
super.
doing some
Well,
NASCAR content while I'm in Phoenix next week. So I'm looking forward to that as well. But like
that
Chris
should be good
said,
fun.
we are live today, and we are looking to be live every week from now on. So if you want to know when we are going to be on, go ahead and hit that follow button and like and follow and be notified.
Yeah.
Hit the bell to be notified, and we will let you know when we are going to be online. So we look
Let's
forward to
go.
it. So
Yep, wonderful, wonderful, wonderful. Well,
have a
thank you
great
again for
weekend,
joining
Chris.
us for
Enjoy
On
the
the
birthday
Rocks.
parties.
Jay, have a great weekend yourself. Yep,
See ya. See ya,
we'll
everybody.
talk again next week.